I'm very glad to be here with you this evening. Indeed, delighted to participate in this annual convention of MFDs, very appropriately titled Ignite. Addressing a very large audience of very active MFDs is indeed a proud privilege and a distinct honor. I thank you for that honor. You already had many presentations today. I think 12 presentations so far today on the economy, the trends in the economy, per capita income, GDP growth, fiscal deficit, current account deficit, macro stability, inflation trends, what the central banks world over are doing, what RBI is likely to do, and all those things. So I don't want to inundate your brain with more data on all these things with which all of you are very familiar. I will take a different path and tell you about, I will focus more on the big changes, the macro changes that are happening in the Indian economy. And also I will share my own experience as an investor in the market. During the last 40 years, I started investing in 1984 when the Sensex was around 320, 340 range. I will share my experiences also, which I think is very, very important. I was introduced as an economist. Unfortunately, economists are not very popular with people. Economists sometimes make very wrong predictions. Rakesh Jhunjhunwala was always suspicious about economists. He used to say that if I had listened to economists, I would never have invested in the market. But sometimes economists get it right, sometimes they get it wrong. In 2008, at the height of the global financial crisis, a friend of mine sent me a mail about the story of a Harvard professor, perhaps with the intention of taking a dig at the economist profession. So the story goes like this. A very famous Harvard economist, a very esteemed, highly respected economist who had a global reputation in algorithms, mathematical economics. He once decided to take a short vacation along with his family. So he took his family for a few days and went to a Scandinavian country, a remote countryside. So one morning he was jogging, and while jogging, he saw a shepherd rearing his herd of sheep. So immediately he thought about his daughter. His daughter loved sheep. So he went to the shepherd and told the shepherd, "Mr. Shepherd, if I tell you exactly how many sheep you have in this flock, will you give me one?" The shepherd thought, there is no way this stranger will know how many sheep I have. Even my wife doesn't know. So he said, yes, certainly yes. Then this economist took out his latest mobile phone, Apple mobile phone. He sized up the flock of the sheep and then did some very quick mathematical calculations and said, "You have 346 sheep." The shepherd was shell-shocked because he never expected this answer. And he said, "Okay, you can take one." So this very victorious economist took one and was running back to the hotel. After some time, the shepherd came running after him. When he caught up with the Harvard professor, he said, "Wait a minute, if I tell you what your profession is, will you give that animal back to me?" So the Harvard professor thought, there is no way this shepherd will know who I am. He said, "Yes, certainly I will." Then the shepherd said, "You are an economist." This time it was the economist who was shell-shocked, and he said, "You are right, but how did you know?" Then the shepherd said, "Sir, you picked up my dog, assuming it to be sheep. And if you don't know the distinction between sheep and dog, you must be an economist." This is the reputation with which economists are held these days. I belong to that tribe. So with that anticipatory bail, let me go into my thoughts on the economy and the markets and where we are headed in the next several years. One established fact, irrefutable historical experience about market movements is that the market trends are determined by economic growth and corporate earnings. As Benjamin Graham, Warren Buffett's guru, famously said, in the long run, the market is a slave of earnings. We know that. In 1995, the base year of Nifty was 1,000 in 1995. Now the Nifty is hovering around 25,000. If you calculate it, it is a 12% CAGR. 12% CAGR, close to 12% CAGR. And what has been the corporate earnings growth from 1995 to 2024? Exactly 12% CAGR. So in the long run, market is a slave of earnings. In the short run, there can be huge volatility. There can be geopolitical issues like what we are having now. There can be economic cycles. There can be sharp downturns in the economy, like what happened in 2000, like what happened in 2008. We know the COVID recession of 2020, very fresh in our memory. All these issues will be there. In the short run, the market can be excessively volatile. Some friends ask me, people who are not exposed to the market, tell me, Vijayakumar, what is this utter madness in the market? At 11 o'clock, the Nifty is at at one level. At 3 o'clock in the afternoon, the Nifty is at a totally different level. This is sheer madness. I tell them you are right. In the short run, there is madness. But if you are a discerning observer of the economy and the markets, you can discern a madness in that, a method in the madness. That's what you create. A method in the madness. And this method in the madness in the long run is corporate earnings. That's why Benjamin Graham famously said, the market in the long run is a slave of earnings. So if you can ignore the short run volatility in the market, well, the short run madness is totally insignificant and totally irrelevant. Now there is a consensus globally among all the think tanks. I'm not talking about Government of India's projections or the RBI's projections. You can take them with a pinch of salt because that is always the case. But then you take IMF's projections, the World Bank's projections, OECD's projections by major investment banks in the world. There is a consensus that India will be the fastest growing large economy in the world for many years to come. There are projections of an $8 trillion economy by 2032. And in the recent book written by Krishnamurthy Subramaniam, who's presently the director at the International Monetary Fund, formerly chief economic advisor, in his latest book, he is projecting a GDP of $55 trillion, more than 12 times India's GDP now, by 2047, when we will be celebrating India's centenary of independence. Now, if you look at the history of India's economic growth, this is important, the historical context is important. We can divide India's economic growth story into three distinct parts. First is 1950 to 1980, the first stage, 1950 to 1980. Second stage is the 1980s, 80 to 1991. And the third stage is post-1991, post-liberalization, post-economic reforms in 1991. Let me very briefly summarize these three trends for you. Then only you will get the big picture in a correct perspective. That is very, very important. After independence, India, unfortunately, if I may use that word, adopted the most popular economic policy at that time. Nehru also was influenced by the Soviet model, which was a success at that point of time. And therefore, we adopted an economic policy based on commanding heights. That is, commanding heights of the economy will be in the public sector. Public sector was given the dominant role in the economy. And also, we adopted the Soviet model 5-year plans. So the public sector plus centralized planning was India's economic strategy, which was popular at that point of time, but we continued with that policy. And consequently, during this period, 1950 to 1980, India's GDP growth was only 3.5%, what is referred to the Hindu growth rate, low growth rate, compared to the high growth rate experienced by many other countries of Asia, newly independent countries. They started growing faster than India. India grew only by 3.5% in these 3 decades, 1950 to 1980. And that was the time when India's population growth was 2.3%. So when your GDP is growing at 3.5% and your population is growing by 2.3%, your per capita income growth is 3.5 minus 2.2, only 1.2. So when your per capita income grows only at 1.2%, what happens? Apply the rule of 72. All of us are familiar with the rule of 72. 72 divided by 1.2 equals 60. That means it takes 60 years to double your per capita income. At 1.2% per capita income growth, you need 60 years to double your per capita income. So that means with low per capita income, demand will be very sluggish. Companies will experience only very poor demand. The corporate growth will be low, profits also will be low, and we had very high rates of corporate tax at that point of time. And therefore, Indian stock markets did not deliver at all in these 3 decades. Stock market performance was not given much importance by the government also. Youngsters might find it surprising to know that the government decided how much dividend a company should pay. How much dividend a company should pay was decided by a joint secretary in the Ministry of Finance. There was a maximum limit on the dividend that a company could pay. Even till 1991, even in 1991, we had the controller of capital issues, which gave permission for rights issues, bonus issues. I remember companies deciding to pay 1:1 bonus, but the controller of capital issues says, no, you cannot pay 1:1 bonus, you pay 2:5 bonus, as though the joint secretary in the Ministry of Finance knew more about the company than the company management did. So that was the old time. Things started changing in the 1980s when the initial dose of liberalization was introduced under Rajiv Gandhi. It was a period of initial dose of liberalization. And the GDP growth moved to a higher trajectory. From 3.5% GDP growth, we moved to 5.6% GDP growth, and companies started growing, revenue started growing, profitability started growing, and for the first time in India's history, stock market returns started beating returns from other asset classes, and for the first time, stock market returns beat inflation. That was in the 1980s. Unfortunately, this high growth of 1980s could not be sustained. In 1991, we had the big crisis in India, the balance of payments crisis in 1991. When I used to teach economics in college, I used to tell my students, fortunately, we had that balance of payments crisis in 1991, because in the absence of that crisis, we would not have reformed, because politicians will always take bold decisions only if there is a crisis. Right? As John Maynard Keynes, the famous economist, said, politicians will do the rational thing, but only after exploring all other possibilities. So in India, we were exploring all other possibilities, but when faced with a major balance of payments crisis in 1991, we had no other option but to reform the economy, to liberalize the economy, and under the visionary leadership of one of India's best prime ministers, Narasimha Rao, whom I hold in very high regard, we started liberalizing the economy. And post-liberalization, India is the second fastest growing large economy in the world now. Not now. If you take the 1992 to 2024, India is the second fastest growing large economy, second only to China. And our stock market performance, if you take the last 10 years, it is the same as the best performer USA. If you take the last 20 years, India is the best performing stock market in the world, whereas the Chinese stock market is not performing. Of course, last 1 month has been different. If time permits, I will come to that later. Why this FII strategy of sell India, buy China, that is a short-term tactical trade, unlikely to be a long-term trend. So post 1991, India started doing exceedingly well. Corporate profits increased. Some of you might find this data surprising, particularly young people. In 1991-92, the first year of liberalization in India, the net profit of the Indian corporate sector, the net profit of all companies in India put together was, can you make a guess? How much? The net profit of all companies in India put together in 91-92? Just 7,400 crores. TCS in the last quarter made more than 12,000 crores. And today we had the total profits of HDFC Bank, which is more than 16,000 crores. There are many companies in India in one quarter making more profits than the profits earned by the entire corporate sector in 91-92. Interesting data is the net profit earned by many companies now is more than their total turnover in 1991-92. The same story will repeat. By 2035, 2040, the net profit of many companies will be more than their present turnover. Some economic data are incredible, very difficult to believe, but these are very interesting times. So India has been the fastest growing economy, and presently we are the fastest growing large economy in the world. In the previous presentation made by my friend from HDFC, he had given the trend of HDFC. I mean, HDFC's projection of, not projection, the actuals of the last 3 years and the projections for this year also. India will be growing at more than 6.5% if you take the last 4-year average, and no other economy comes anywhere near that. And also we are at a time when other economies are slowing down. China is experiencing deceleration in their population growth. And in economic history, there is not even a single instance where an economy which is a country which is experiencing decline in population growth grows at more than 3%. That has never happened in global economic history. India has a very young population. That's why we always talk about the demographic dividend, the young population and the demographic dividend. Therefore, our growth trajectory will sustain for a long period of time, completely altering India's corporate scenario, corporate earnings growth. 10 years ago, in 2014, India was the 10th largest economy in the world in 2014. Now, in 24, we are the 5th largest economy. And barring unforeseen circumstances, 99.99% probability is that India will be the 3rd largest economy in the world by 2027, because Japan is growing at best 1.5%. Germany is almost stagnating at 1%, the sick man of Europe, even though it is a very vibrant economy. Whereas for India, 6.5% growth can be taken for granted. So India will be the 3rd largest economy in the world by 2027. And a very important point is, let me take the same example that I shared with you. In 1950s, 60s and 70s, our per capita income growth was 1.2%. So applying the rule of 72 divided by 1.2 equals 60. It took 60 years for doubling the per capita income. Now, our growth potential, potential growth rate is 8%. We can easily reach that with some bold reforms which are happening. And with 8% GDP growth and population growth declining to 0.8%, our GDP growth is 7.2%. Short-term, medium-term trend. 7.2% per capita income growth. Again, apply the rule of 72. 72 divided by 7.2 equals 10. Your per capita income is doubling every 10 years. And particularly when the per capita income moves from, there is something called a J curve in economics. So we are at the trough of the J curve and started moving up like in a hockey stick. Our per capita income now is about $2,500, roughly around $2,700. We can easily double to more than $5,000. So when the income explodes from 2,500 levels to $4,000, $5,000 per capita income, consumption can really pick up. Because even now we must understand, only 7% of Indian families own a car, only 7%. The reason why the Hyundai share is trading in South Korea at a PE of 5. And the reason why the Hyundai subsidiary in India is issuing the share at a PE of around 22 is there is stagnation for the automobile industry in South Korea where almost every family has more than a car. I'm not justifying Hyundai's pricing. I believe that even though the issue has been fully subscribed, probability is that it may list at a discount because for such a large issue, the pricing has been excessive. That's a different story. So what I'm trying to say is the growth potential is very high in India. Even now, if you take 3 or 4 consumer durables, like air conditioners, washing machines, refrigerators, you take these 3 products as a group, only 15% of Indian families own these 3 products. So look at the potential of growth. And that is why consumer durables companies have very high valuations and investors are prepared to pay a high premium for these companies for whom the growth story is very, very bright. Now, there is a consensus now, many investment banks have written about this, that India can be an $8 trillion economy by 2032. Of course, I told you about Krishnamurti Subramaniam's projection of $55 trillion economy by 2047. I don't think too much about that because I will not be around in 2047. But looking at the near term of 2032, if we can sustain, we did not do anything magical. If we can sustain GDP growth of the present trend of GDP growth, we can be an $8 trillion economy by 2032. And it's quite likely that by 2032, our market cap can be 10 trillion. Present market cap is 5 trillion. The most important point that you have to understand is, we took how many years? More than 75 years since independence to reach $5 trillion market cap. The next 5 trillion will happen in 8 years. So the wealth that has been created in the Indian stock market during the last more than 75 years is going to be created in the next 8 years. This is a phenomenal, incredible, unprecedented opportunity. Very few people realize the historical significance of this. In 2008, after the global financial crisis and the stock market crash, one day I was listening to the CNBC and a very smart interviewer, Maria Bartiromo, that lady anchor of CNBC, very smart, she was interviewing Warren Buffett. She asked him a very interesting question. She asked, Mr. Buffett, many books have been written about you. Many biographies have been written about you. We have read all that. Your investment strategy is being taught in universities. We know all the details regarding your investment strategy. But are there any factors which contributed to your success that is not in the public domain? That is the question. Are there any factors that contributed to your success which we do not know, that has not been mentioned in any of these books? Warren Buffett, with a twinkle in his eyes, said, yes, there are two factors. I was also very curious, what are these two factors? Buffett said, nobody has spoken about this. There are two factors that contributed to my success. One, I was born in United States of America, not Somalia or Nicaragua. Second, I was born at this very vantage point in history when the US economy became the largest economy in the world. If I were born 250 years ago, USA did not exist. Imagine I was to be born 100 years from now, another economy, maybe India, he did not say that, another economy may be the large economy in the world. So I was very fortunate to be born in the right place at the right time. So being in the right place at the right time is the most important thing. So we are very fortunate to be in the right place at the right time. And all of you are very fortunate to be in the right place at the right time. This is hugely significant. This is hugely significant. My parents could not invest in the stock market. Simple, they did not have money to invest. And even if they had money to invest, well, investment would not have given any returns because that was the 1950s, 1960s, 1970s when this economy was growing at insignificant growth rates. So I succeeded as an investor, a modest, successful investor, because partly, maybe only partly because of my investment expertise, if you can attribute something to that. But I would say the most important factor that contributed to my success as an investor is that I happen to be living in India, particularly at this point of time. When I address investor conferences, some people asked me recently in a conference of chartered accountants, a very intelligent chartered accountant, even though chartered accountants are very smart finance people, many of them are not good investors. You might be knowing that, many of them. In a chartered accountants national conference where I was the keynote speaker, this was I think it was in 2008-9, immediately after the global financial crisis. So the president of Chartered Accountants Association began his presidential address saying that, fortunately, I did not invest in the market, right? So I told him, you are wrong, right? So it is very important that we have to understand the historical context. So people ask me this. So I tell them from my experience. I started investing in 1984. So Sensex, even though Sensex has the base year, 1979 as the base year, we know Sensex came into existence only in 1986. So the corresponding figure of Sensex in 1984 was around 320, 340 when I started investing in a small way in the market. After that, I have seen many, many scams in the market, crashes in the market, disasters in the market. A few months after I started investing, Indira Gandhi was assassinated. Not because I started investing. Indira Gandhi was assassinated when we had a major political crisis. We had the Khalistan movement. Punjab was almost on the verge of breaking away from the country. Then we had the Babri Masjid Ram Mandir issue, demolition and the communal violence associated with that, and the assassination of Rajiv Gandhi, another very sad, tragic disaster, political disaster for India. Then we had a 1991 balance of payments crisis, a minority government under Narasimha Rao. Then we had two major stock market scams with which you are familiar, the Harshad Mehta scam, 1992, the Ketan Parekh scam of 2000. We had the Kargil war with Pakistan. We had many natural calamities, droughts, floods, earthquakes. We had the sanctions imposed against India after the nuclear explosion boldly done by the Vajpayee government. Then we had the 2000 global tech bubble burst, the Twin Tower attack, and the crisis that followed. Then in 2008, we had the global financial crisis. And in 2020, recently, we had this once in a century kind of pandemic which wreaked havoc with the economy. This is my experience. But in this experience of last 40 years, what happened? I saw the Sensex move from 340 to 1,000, 2,000, 5,000, 10,000, 20, 30, 40, 50, 60, 70, above 80,000. The journey is certainly not going to be smooth. I'm very optimistic about the same trend continuing for the many years to come, because India's growth story is so bright, it is inevitable. But the journey will not be smooth. There can be problems. Some people asked me, even a couple of days back, after a brief discussion, one person asked me, so there's a war in the Middle East. The war is continuing in Ukraine. So how can we invest now? Let us wait. No. If you wait for the correction in the market, as Buffett famously said, more money is lost in waiting for the market than that is lost in the market itself. So any time is the right time to invest, particularly if you are investing through mutual funds, particularly through the systematic investment plans. I've been very saddened by the huge losses being incurred by the newbies into the market. Our total demat accounts in April 2020 was 4.09 crores. Now it is more than 17.5 crores. But 80% of the newbies in the market have not seen a bear market. They don't know much about the market, and therefore they are going into the futures and options market and burning their fingers. So of course, we are benefiting from, mutual fund distributors are benefiting from the India growth story. But we also have a responsibility to handhold the investors in the right direction. Don't go to the F&O market. Don't speculate in the market and lose money. 90% will be losing money. At the same time, if you are a systematic investor in the mutual funds, 99.999% you will make money. You will lose money only if you make some stupid decisions which we can avoid. So I've already exceeded the time by 5 minutes. Thank you very much for giving this opportunity for me. It was a pleasant experience talking to you. Thank you very much.
Thank you, Dr. V.K. Vijayakumar ji, for that beautiful presentation, which has really come out of your heart. No paper, no PowerPoint, nothing. That shows the passion which you carry along with you while speaking about economics, market, econometrics, whatever it is. Thank you so much. Can we have the lucky draw now, which will be drawn out by Vijayakumar sir? Number 008. 008. Yeah, please come running. Next number 407. 407. And the third number 002. 002. All the three members are here. Can we have Mr. C.S. Warrior, sir, to kindly come forward to hand over a token of our appreciation to Dr. V.K. Vijayakumar. Once again, please put in a big round of applause for Dr. V.K. Vijayakumar from Geojit Financial Services. A standing ovation. AIFA is indeed proud, privileged and happy to have him amongst us this evening. So this shows the love and affection we have for you.